Happy Tuesday, everybody. Welcome to a short week. Once again, a work week without a Monday, my favorite kind. I hope you all enjoyed your long Labor Day weekend. It was a pretty heavy one for many of us with what happened in Israel. But as always, I'll try to stay focused on the economics and not the politics. Today is September 3rd, 2024, and this is your Tuesday market update. I was noting yesterday that we've started the final month of the third quarter. The question is, are you where you want to be? Please, let's talk about that. The end of Q3 and certainly Q4 are bound to bring a lot of noise and some signal too, so we'll keep that in mind. Let's review last week's market action and we'll preview the coming week. Monday, the market experienced elevated volatility as traders reacted to the latest economic data and looked ahead to major earnings release later in the week. The day began positively with an early rally fueled by a strong headline number in the July durable goods report. However, the underlying data of that report were weaker, tempering enthusiasm and reinforcing expectations of a potential 25 basis point rate cut by the Fed this month. As the day progressed, concerns about the economy were heightened by the comments from Fed officials and negative geopolitical developments, particularly in the Middle East, where Israel's failure to reach a ceasefire agreement with Hamas and a preemptive strike on Hezbollah added to the market's caution. Despite these pressures, the S&P 500 managed to hold above its support level and end of the day off its lows, though still in the lower half of its trading range. The Dow closed up less than 0.25%. The S&P closed down 0.33%, closing off its earlier highs as profit-taking in the mega cap stocks did weigh on the index, and the Nasdaq saw a more pronounced decline due to weak earnings in the sector. Not big name weakness, but any weakness in a fragile market was not good. The Nasdaq closed down just a bit over 0.75%. News from the Middle East and oil was up almost 3% on the day. On Tuesday, markets gapped lower, driven by a pullback in large cap tech stocks, as investors positioned ahead of Nvidia's earnings. We're going to hear that a lot this week. The market quickly stabilized as mixed housing data and better than expected consumer confidence data did provide some support. A strong 2-year Treasury auction and reassurances from former Fed head Mester, who expressed confidence that the Fed was not behind the curve, also contributed to the market's recovery. The S&P 500 did hit a new session high in the final hour, but it lacked follow-through, ending the day near the 56.25 mark. Markets did manage to recover from earlier losses and end the day with modest gains as investors digested unexpectedly strong consumer confidence data while largely focusing on the upcoming earnings release from Nvidia. The Dow was up very slightly. The S&P 500 and the Nasdaq both rose just under 0.25%. Oil gave back 2% as the news in the Middle East was not as bad as was feared. The market's defensive sectors like utility and real estate continue to outperform, indicating that investors are pricing in peak interest rates and moving into safer, more value-oriented sectors. Meanwhile, energy and consumer discretionary were the worst performing sectors, reflecting concerns about weakening economic growth. We've talked about that. Wednesday, the market experienced increased volatility as traders positioned themselves again for Nvidia's earnings report. It seems like we positioned the whole week, which was seen as a significant catalyst for the week. Of course, the S&P 500 did drop over 1% during the session, but managed to recover some of those losses by the close. Trading day began on a weak note, with major indices gapping lower despite the absence of any significant negative headlines. Geopolitical tensions in the Middle East and cautious comments from Fitch on China contributed to the negative sentiment, but were not the primary drivers of the sell-off. Instead, declines were largely attributed to positioning. Surprise, surprise, ahead of Nvidia's earnings, which are heavily weighted in the tech sector, of course. A weak 5-year Treasury auction added to the pressure, pushing yields higher and further weighing on stocks, particularly in the tech sector. In the final hour of trading, news that OpenAI was initiating a new fundraising round with a valuation exceeding $100 billion led to a wave of profit-taking in mega-cap tech stocks, exacerbating the losses. Nvidia's earnings report, well, we waited for it. While positive, with the company beating both earnings and revenue estimates and raising Q3 guidance, failed to meet the high bar expectations that the market had set. This led to a 3% decline in Nvidia stock after hours, further fueling concerns about the sustainability of the recent tech rally. The Dow was down 1/3%. S&P, as I said, was down a bit over 0.5%, and the Nasdaq down almost 1.25%. Oil still bouncing around, down over 1%. The day's action highlighted concerns that market momentum, particularly in tech, may be faltering. Rising questions about the market's ability to continue to rally in the face of slowing growth and a challenging macroeconomic environment. Thursday, the stock market remained volatile as investors digested Nvidia's earnings. Again, we can't get away from that one today. Analyzed upbeat economic data and reacted to the late rate rise in Treasury yields. The market opened higher, supported by modest decline in Nvidia, 3 to 5%, that did not spark widespread selling in other mega cap tech stocks. Encouraging global economic news, particularly cooler than expected inflation data from Spain and Germany, helped boost markets early in the day. Additionally, a solid 3% U.S. GDP growth print and positive consumer spending metrics eased recession concerns, driving an early rally. The rally did lose momentum as comments from Fed head Barkin highlighted the fact the Fed was not yet at its 2% inflation target, causing the S&P 500 to stall at 5650 around midday. The market faced further pressure following a disappointing 7-year Treasury auction, which led to a rise in bond yields and added to the late day selling. Tech was the clear laggard, declining overall by about 1%, primarily due to, of course, Nvidia's earnings, which saw a 6.5% drop for the stock price. Dow closed up 0.5%. S&P essentially was flat, and the Nasdaq was down 0.25%. Oil kept up with the up and down, this time up about 2%. Overall, the solid economic data drove market internals, with the rotation from tech into cyclicals continuing. The market's focus remained on the potential for a soft landing, though concerns are still about growth and inflation are still front and center. Friday brought the big eco data number of the week, the PCE, the one that the Fed has said that they pay a lot of attention to. And when the time came, the numbers matched the estimates, so not much to react to. Stocks opened slightly higher as the month-end positioning also played into things. University of Michigan data consumer sentiment numbers were slightly lower than expectations. As Warren Buffett celebrated his 94th birthday, he had a lot to celebrate as Berkshire Hathaway became the first non-tech company to eclipse the $1 trillion market cap number. By the way, fun fact, Berkshire Hathaway currently owns more U.S. Treasury bonds than the Federal Reserve. 60 stocks in the S&P hit 52-week highs, and one, Dollar General, hit a 52-week low. As the month and week came to a close, I've been focusing you on earnings, and Q2 turned out to be a good one for earnings. All but 7 stocks have reported from the S&P at this point. S&P Q2 earnings growth rate is about 13%. That's the strongest since Q4 of 2021. Stocks did close higher on Friday, capping off a volatile month on a positive note. Dow was up 0.5%, S&P up 1%, and the Nasdaq up almost 1.25%. A big bunch of month-end, weekend, day-end buying on Friday. For the week, the major averages closed on a strong note. Dow was up nearly 2% on the week. S&P with its 4th consecutive monthly gain, up 2.33% in August, and the Nasdaq up about 0.75%. The S&P's recovery from a sharp sell-off early in the month, where it lost as much as 7.25%, highlights the market's resilience, closing the month with gains in consumer staples, real estate, and healthcare sectors. August 2024 was a month marked with significant volatility in the stock market, with the most volatility in 2 years, but it ultimately ended on a positive note, as we said. Dow was up 1.75% with new record highs for the month. That was after beginning the month with a 5.5% drop. The S&P gained 2.33% for the month, marking its 4th consecutive monthly increase. This came after a sharp drop earlier in the month, of course, where the S&P had lost as much as 7.25%. The tech-heavy Nasdaq managed a modest 0.75% gain for August. The index faced significant challenges, of course, particularly from the sharp sell-off in AI and tech-related stocks, but recovered towards the end of the month. Volatility was driven by fluctuating investor sentiment around interest rates and tech earnings. Overall, August was a month of recovery after early volatility, with the major indices closing higher and defensive sectors leading the way as investors navigated economic data and central bank signals. Looking to this week, of course, yesterday, markets were closed for the Labor Day holiday here in the U.S. That may be the only quiet day this week. We'll start today with manufacturing PMI, and then right into the meat of the week with jobs numbers, JOLTS tomorrow, ADP and jobless claims on Thursday, and the non-farm payrolls on Friday. We know from Jay Powell himself that they are focused on the labor markets, and any strength or softness, or strength, I guess, any sign of softness or strength, I guess. Eco data is still coming with Beige Book and services PMI, and the Fed heads are back late this week, Williams and Waller on Friday. Few of those stragglers will report their earnings, so keep an eye out for those. I still think the focus, although the media will focus on jobs and the Fed, the focus will be on what they will see. And that is if the economy is slowing too fast and if growth is falling off a cliff. That is the fear. And labor and the rates, that's just their action items. The next Fed meeting is September 17 and 18. And there's a lot to be reported for that. Yes, this week's labor numbers, but also coming inflation data. And I will contend that's the most important. Eco numbers for growth. That will be what we have until earnings starts again until October 11th. There is no shortage of news this week. Please remember that much of this is the noise, not the signal. So please stay in touch. Let's stay focused on your goals. Come back on Friday for more from the planning side. And until then, stay in touch as the trading desk and offices everywhere repopulate after the summer. Have a great week.